Did you know that over 80% of millionaires have less than 10% of their wealth in the bank? The rest is working around the clock, making more money while they sleep. Let's uncover why. Have you ever wondered why millionaires and billionaires don't keep their money sitting in banks like the rest of us? We imagine that wealthy people have vaults full of gold or bank accounts with endless zeros, but that's a myth. The truth is, the rich almost never let their money sit. It's always moving, always working, and always growing. Banks were designed to store money, but storage doesn't equal growth. When you put your money in a savings account, it loses value every year because of inflation. Meanwhile, the bank takes your money, lends it out at higher interest rates, and earns massive profits. The bank gets richer, while you get cents in return. The rich understand this game. They know that money is a tool, not a treasure. Keeping cash idle is like parking a Ferrari and never driving it. So instead of saving, they allocate. They put their money into assets that multiply: real estate, businesses, stocks, private equity, and more. They use leverage, tax strategies, and compound growth to make money work for them. In this video, we'll uncover the 5 key reasons why the rich never keep their money in banks, and what you can learn from them to start building wealth like they do. By the end, you'll realize it's not about how much money you earn. It's about how intelligently you move it. Let's dive in. The first secret lies in mindset. The rich don't see money as something to be saved. They see it as energy that must flow. This mental shift completely changes how they behave financially. For most people, money is emotional. It represents safety, comfort, and control. So when they earn it, they hold on to it tightly, putting it in savings accounts, afraid of losing it. But the wealthy know that security doesn't come from saving, it comes from creating. They see money as a seed, not a fruit. If you eat the seed, you'll never have a harvest. Let's break that down. A rich person earns $10,000. They don't think, how do I keep this? They think, where can I plant this to make it grow? That's why their money is always circulating through investments, startups, properties, and ventures that generate cash flow. They value cash flow over cash storage. Their goal is to build systems that continuously produce income, not pile up stagnant savings. This mindset comes from financial literacy. The rich understand inflation. They know that $100,000 today might buy less next year. They understand opportunity cost, that money sitting idle is losing potential returns. And most importantly, they understand that money follows value. When they put capital into value-creating activities, it multiplies. For the average saver, the fear of losing money is greater than the desire to make it grow. For the rich, it's the opposite. They take calculated risks because they trust in their ability to recover, learn, and pivot. That's why you'll often hear wealthy people say, if I lost everything today, I'd make it back in 5 years. They know the true asset isn't the money, it's their mindset. In short, the rich think like investors, not depositors. They don't see money as something to hoard, but something to deploy. That's why they never let it sit in banks. They make it work, 24/7. People often think banks are the safest place for money. But ironically, the rich know that's one of the riskiest long-term strategies. Why? Because of invisible losses. The first invisible loss is inflation. Every year, your money loses purchasing power. If inflation is 6% and your bank gives you 1% interest, you're losing 5% of your value annually. The rich understand this erosion effect deeply. They'd rather have their money in assets that outpace inflation, like real estate, businesses, or commodities, than see it silently shrink in a safe account. The second risk is bank leverage. Banks don't actually keep your money. They loan it out multiple times through a system called fractional reserve banking. That means your deposit isn't really sitting there. It's being lent to others at much higher rates. So while your savings earn you peanuts, the bank earns massive spreads using your money. Third, there's systemic risk. The danger of financial crises, bank failures, or currency devaluation. The 2008 financial crisis showed that even giant banks can collapse. When this happens, depositors are left vulnerable, and even government insurance has limits. Wealthy individuals diversify far beyond banks to avoid being trapped in such events. Another often ignored risk is opportunity loss. Money sitting in the bank does nothing. It's safe but sterile. The rich see that as wasted potential. They'd rather deploy it into productive ventures, a rental property, a dividend-paying stock, or a business partnership, something that brings consistent returns and tax advantages. Finally, the rich understand that control is power. When your money is in a bank, you're under the institution's control. They can freeze accounts, limit withdrawals, or delay transactions. By contrast, when your capital is tied to assets, you have control. You decide when to buy, sell, or reinvest. In essence, the wealthy don't avoid banks because they're paranoid. They avoid them because they understand the math and the system. Banks are built to make money from you, not for you. So if the rich don't keep their money in banks, where do they keep it? The answer: in assets that appreciate and generate income. Let's start with real estate. It's a cornerstone for the rich because it combines cash flow, appreciation, and tax benefits. They buy properties that produce rental income, use leverage to acquire more, and enjoy appreciation over time. Plus, real estate provides protection against inflation. As prices rise, property values and rents increase too. Next is business ownership. Most millionaires don't get rich by saving. They get rich by owning. That could mean owning their own companies or investing in others through private equity or venture capital. Businesses create value, jobs, and profits. And with the right structure, they can grow exponentially. Another major destination is the stock market, but not just savings in index funds. The rich often invest through tax-advantaged accounts, long-term holdings, and ownership stakes. They understand compound growth and diversification. They use the market to let their money work globally, 24 hours a day. Then there's alternative investments: gold, art, cryptocurrencies, and collectibles. These act as hedges against inflation and market volatility. The wealthy use them not for short-term gain, but as strategic preservation of value. And let's not forget private lending and passive income ventures, from angel investing to royalties and online assets. The goal is always the same: move money from storage to circulation. Finally, they maintain liquidity buffers, but not in savings accounts. Instead, they use high-yield funds, money market accounts, or short-term bonds that provide quick access without sacrificing returns. In short, the rich spread their capital across productive income-generating and appreciating assets, never idle cash. Because idle money dies, active money multiplies. One of the biggest secrets of the wealthy is leverage, the art of using other people's money to build wealth. Banks borrow your deposits and lend them at higher rates. The rich do the same, but in reverse. They use debt strategically, not consumer debt, but productive debt. For example, a wealthy investor might take a $1 million loan to buy an apartment complex that produces $10,000 a month in cash flow. The tenants pay off the loan, and the investor keeps the property and the profits. That's leverage. They also use tax leverage. The rich know the tax code rewards investment and productivity. By owning assets, they access deductions, depreciation, and capital gains advantages that savers never touch. In contrast, money sitting in banks is taxed through inflation and low returns. Leverage also applies to time and systems. Wealthy people delegate, automate, and scale. They invest in businesses and technologies that make money while they sleep. They don't trade time for money. They trade strategy for freedom. And here's the kicker: leverage isn't just financial. It's intellectual. The rich invest in learning, understanding markets, finance, and systems. That knowledge compounds faster than any interest rate. In summary, leverage allows the rich to multiply their capacity. They don't keep money idle because every dollar can be turned into 5, 10, or 100 through smart leverage. That's the secret engine behind their wealth. Not savings, but systems. Now that you understand the mindset and methods of the rich, the next question is, how can you apply it? First, educate yourself about money. The rich treat financial knowledge as their greatest asset. Learn how cash flow works, understand investments, study how taxes impact your wealth. The more you know, the less you fear risk. Second, build assets, not accounts. Instead of focusing on how much you can save, focus on what you can own. That could be a side business, rental property, or even a portfolio of dividend stocks. Ownership equals freedom. Third, manage your risk but don't fear it. Every investment has risk, but so does doing nothing. Inflation, layoffs, and stagnation are risks too. Take smart, educated risks and diversify. Fourth, develop multiple income streams. The average millionaire has at least 7. Whether it's through digital products, investments, or businesses, create layers of income that reduce dependency on one source. Finally, think long-term. The rich don't chase quick wins, they play the compound game. They let time do the heavy lifting. Remember, the goal isn't to get rich fast. It's to get financially free permanently. You don't need millions to start. You just need the mindset to act like one. So here's the truth. The rich never keep their money in banks. Not because they hate banks, but because they understand money's true purpose. Money isn't meant to be stored. It's meant to move. It's a tool, a servant, not a master. While most people let fear dictate their financial choices, the rich let strategy guide them. They don't chase comfort. They chase growth. They don't hoard. They build. They don't save. They invest. The difference between the wealthy and everyone else isn't the amount in their bank account. It's the way they think about that amount. You can start today by shifting your mindset from saving to scaling, from holding to building. Because the truth is, you don't become rich by keeping money. You become rich by making money move with purpose. So stop letting your money sleep in the bank. Wake it up, put it to work, and watch it multiply.